You're listening to another episode of the Young Investors Podcast, so sit back and relax as myself, Brandon, and my buddy Hamish discuss the latest in the world of finance and stock market investing. Now, a quick reminder before we get into the podcast is that nothing in this podcast should be taken on as personal financial advice. If you're ever unsure about your finances or investing and you need some help, make sure you reach out to a qualified financial advisor. But with all that said, let's get into another episode of the Young Investors Podcast.
All right, everybody, welcome back. Welcome back, Brandon. I've actually got some exciting news this week. I finally started recording in my new space. Yeah, so
nice.
It's not finished, but I mean, as I've mentioned, I mean, with these, we've been in lockdown for like a good portion of the past couple months now, so that's kind of been made it difficult for me to do some of the things I wanted to do with the space, but it's at a point now where it's acceptable for me to record in it. I don't have anything in the background, but yeah.
Have you recorded anything in it yet?
I've recorded one video. It's not, well, actually, it should be out by the time this podcast is out. It's not out right now, but it will probably be out by Saturday. It should be. So, it's, I've got, I got some of the soundproofing, enough of the soundproofing and the lighting and stuff. So, that's all set up. The backdrop is just completely plain at the moment, but I thought it would be kind of cool to just like record in it, and then it'll hopefully motivate me to fill the background, and then you can kind of see how it changes over time.
Yeah.
So we'll,
set up a PO box, and then we'll each send you a little knick-knack for you to put in your background. we'll fill like a shelf with just random junk.
I actually have a PO box because I needed a registered address because I didn't want to put my
Actually, I do too, technically.
I haven't like shared it anywhere or anything, but technically I do have one. So maybe I'll have to put that in my description and get people on board.
I'll send you a real life, like a Bitcoin coin, like an oversized Bitcoin coin that you can put in a shelf in the background of YouTube videos. That'll give you lots of credibility. Yeah,
that's good. Can you get me a really big one so I can't fit anything else in the background? Just a huge one.
It's just permanently in the top left of all of your videos, just a massive Bitcoin coin. Jeez, that'd be funny. What a troll. There's no way you'd put that in the background of your videos.
I'm not going to do that. Also, before we do get into today's episode, we've got a couple of different stories to talk about. A couple of Tesla, Elon Musk stories, another story out of China, and I found a funny article out of CNBC that I thought we could go through. But before we do that, before we go through the sponsor, had a bit of feedback from the last podcast. So last week we were talking a little bit about pre-recording the sponsored segment, and someone left us a comment about that. They said, guys, please don't ever do pre-recorded ads. Live reads allow you to bounce off each other, improvise, and have some fun, and to entertain your subscribers and let your personality shine. I love this bit, though. Sharesight loves it when Hamish butchers the ad.
They probably do. They're probably like, man, why can't he ever get it right?
So, I mean, thanks to that, Mark. I wasn't self-conscious at all about the amount of times that I've messed it up, but I'm glad that now people are probably tuning in and hoping that I mess it up as a bit of entertainment in the podcast. But there you go. So
the funniest thing was the time where you said, enjoy, what did you say? Enjoy 4 months free.
25%
That's for
off.
effectively 25% off. Oh dear. Anyway, that was pretty funny.
That wasn't my brightest moment. Was that on a live podcast as well? I feel like that was on an in-person one.
Oh, I can't remember.
Yeah. Anyway, so there's that. Anyway, so with that said, let's get into today's episode by going through the sponsor. And there is no chance I get through this without making a mistake now that I've got that level of pressure on me. But actually, maybe Brandon can do it today. Maybe Brandon can do the sponsor bit today. We can see how you go.
Oh, man. Well, I don't, what do you say? This episode is sponsored by Sharesight. It's an application it actually is an application that I now use as well. And it allows you to track your stock portfolio. It allows you to track capital gains, dividends, dividend reinvestment plans, currency fluctuations. I remember that. But the main reason we use it, Hamish, is when it comes to tax time. And it actually is very helpful when it comes to tax time because it has all these different reports where essentially all of your trading information gets pumped into Sharesight. You just print out these taxation reports, send it to your accountant, or literally just plug the info into your tax return, and then it's done. And the best bit, Hamish Hodder.
What?
Is that you can try Sharesight by heading over to sharesight.com/young investors. That's Sharesight, SIGHT. And you can use that link to get 4 months free when you sign up for a yearly subscription. Did you know that?
Yeah, what percentage off is that off a yearly subscription?
50%.
50%?
Yep.
Someone's going to send an email to Sharesight support and say, but the young investor said I could get 50% off.
Well, technically, you can just access it for free, right? That's one bit of the ad I didn't mention. You can use it for free, or you can save 4 months when you sign up to a yearly subscription. There you go.
Wow, did a good job.
Not too bad.
Probably
not
did
too
a
bad.
better
I mean,
job
it does
than
help
I've
that
ever
I
done.
actually use Sharesight, so I know what it does.
Very good. Where should we start today? Do you want to start with this story you've got at the top? A little bit of a...
sure.
Oh, it's not really a Tesla related. Well, kind of.
It's an electric vehicle story.
Yes. Yeah.
Well, we've just been talking... It's when we come back each week, it's kind of like, whoa, what big name company's gone public this week? There's just
God.
IPOs are just so dime a dozen right now. They're just so common. But now we've got Rivian, another electric vehicle manufacturer, or to-be vehicle manufacturer, just to throw a bit of shade in their direction. They want to go public. So I'll read you the article here. It says, the 12-year-old firm has since February 2019 convinced credible investors, including Ford Motor, BlackRock, and T. Rowe Price, to hand over $10.5 billion between them to help develop its all-electric pickup truck and SUV. And it has some revenue ready and waiting already, with another major backer, Amazon.com, buying 100,000 of its vans. Now, Chief Executive RJ Scaringe has filed confidentially for an initial public offering. There's just one snag, an eye-watering potential valuation of $80 billion.
Get out of town.
Yeah, I know. Well, it gets better. Have a listen. Yeah. Rivian has yet to release any numbers publicly, but chances are it does not make money. That's the case for fellow upstart Lucid Motors too, which just went public by merging with a blank check company and has a market value of $34 billion. Run by former Tesla chief engineer Peter Rawlinson, Lucid trades at 2.4 times its own revenue estimate for 2025.
Love that. When you started reading that sentence, I was like, oh, that's not too bad. 2.4 times 2025 revenue.
Yeah, estimated revenue.
An estimated figure that I'm sure is probably 30 times what their revenue is right now, or something like that. If they're even they're not even making revenue, are they? Very small amounts, I would imagine. I honestly don't know with Lucid, but they're not in high volume production or anything like that. Oh my God.
But anyway, yeah, it's just ridiculous, But this is how ridiculous this Rivian $80 billion valuation is, right? So the article goes on to say, if you apply the same multiple to Rivian, it implies sales in 2025 of $33 billion. That's possible, says Scaringe's firm currently operates one factory with capacity to produce 300,000 vehicles per year and is scouting for a second to churn out perhaps another 200,000. At an average price of $75,000 for one of their pickup trucks, which is currently just above what it's currently charging for orders, at full capacity, Rivian would bring in, if everything went to plan, around $37 billion on that plan. So that's interesting. Okay, so it's possible they could deliver 500,000 cars in 2025. It's a possibility, but we also have to look at where they are right now. And the article quotes, the company, which describes itself as an electric adventure maker, intends later this year to start limited production of its first vehicles, the R1T pickup truck and the R1S SUV, with full production to start in 2022. Rivian is also making, as we said before, the 100,000 electric vans for Amazon.com and intends to have 10,000 on the road by 2022. So they literally have no cars on the road right now. and they're looking for an $80 billion valuation.
Something doesn't quite add up here. So they're gonna intend to have 10,000 on the road by 2022, and then in the space of 3 years, they're going to be doing 500,000 cars a year.
Yes,
I don't think so, but maybe it's possible. As the article said, that's possible. That's what you want to hear when you're investing in a company. When you're describing your investment thesis, it's possible. Just. There's
just a little tiny chance that might happen.
I bought a lotto ticket this week.
Probably you'd be better off buying a lottery ticket.
Yeah, I bought one this week, and I mean it's possible. Just, you know.
Oh golly gee, this is what's interesting. I had a bit of a look. Well, where did I write it? I've lost where I wrote it. Yeah, so there we go. So as per the article, it says they need 500,000 vehicles being churned out per year in 2025 to match Lucid's current valuation. So what I thought we'd do, right, if we gave them to the end of 2025, okay, so it'll be nice to them. So we'll give them like 4 whole years to get something done. So the current leader in the electric vehicle space is obviously Tesla. It took Tesla 8 years to ramp volume vehicle production from 0 to 500,000 per year. They actually hit 500,000 per year just last year.
Wow.
And Tesla has been around for a very long time, but if you say that they started volume production with the Model S in 2012, so they want to get it done in 4 years. It took Tesla, who's been, absolutely increasing production like you wouldn't believe. It's taken them 8 years. So I don't know. And actually this prompted, you'll like this. This prompted Elon Musk to hop on Twitter, as he does. Yeah. And he left a comment on one of these articles about the 80 billion valuation for Rivian. He said, look, don't want to be unreasonable, but maybe they should be required to deliver at least one vehicle per $1 billion of valuation before the IPO. Savage. Absolute savage.
I love Elon Musk.
He's hilarious, isn't he?
Oh, man, just more CEOs need to have a bit of character. Like,
They do.
I know a lot of people don't like how Elon kind of acts, and that, people want him to conform to this like corporate CEO with like a straight face, no emotion ever, even when you leave the office. But like, I don't know, it's kind of fun to have some CEOs with like showing their character. So yeah, but that is kind of crazy. But it's the golden year of IPO. So
Really is, isn't it?
Yeah. Well, I don't know. We'll have to do another update. I think a while ago we did a little update on how many IPOs there had been or something like that. But I'm sure by the time we get to the end of the year, it's going to be a crazy number of IPOs. Everyone's trying to get them in, and I mean,
yeah, wasn't that the article was saying something like it was like halfway through 2021 we'd already passed the 2020 total IPOs.
Yeah.
Yeah, that is pretty insane.
Ridiculous. One other thing that Musk actually spoke about this week, he tweeted a lot of things this week. I mean, I guess he tweets a lot of things all the time, but he actually confirmed, well, I mean, it kind of is a confirmation, but he confirmed that the new Roadster would be coming at 2023 at the earliest, which is a bit painful for people who have already put down the deposit. I think the deposit was a $5,000 credit card charge immediately, and then they had like 10 days to put down another $45,000. Yeah. So big deposit, and of course it's completely refundable if you up until the point where you make sign the lease or whatever, sign for the car. But that's a long time. His tweet specifically said, 2021 has been the year of super crazy supply chain shortages, so it wouldn't matter if we had 17 new products, as none of them would ship. Assuming 2022 is not mega drama, new Roadster should ship in 2023. So he's basically saying that assuming 2022 goes fairly normal, things are starting to get back to normal, and that we don't have, a new variant come, for example, and we go back into lockdown and more shortages or things like that. Assuming that doesn't happen, then 2023 would be the earliest. So kind of disappointing. That's the one thing I kind of dislike about really early announcements of cars, or anything really, because then you have to wait for so long for them to come out. I mean, the Cybertruck, That's not that's even further beyond probably, right? Or do you reckon that will come in front of the...
they're doing the Cybertruck before the before the Roadster. Yeah, the Cybertruck's I think it's about a year away, they said.
Okay.
Well, essentially they're building it in Texas, and they've got to get the Model Ys churned out of Texas, and once they're doing that, then they'll build the Cybertruck factory. But yeah, to be honest, it's just rough times for Tesla because they're just being hampered so much by this chip shortage. It's just insane. Like that's... As Elon Musk said in the last quarterly conference call, you can't make a car without these chips.
Yeah.
And if you have a car which is made of 10,000 unique parts, your production rate is as slow as the slowest part, or is as fast as the slowest part.
Yeah.
And at the moment, they're just being hampered because the slowest part in the supply chain is the chips because it's just such a shortage. So, that you can really understand when he puts it like that. You can understand why traditional auto is just such a hard industry to work in because, I mean, Tesla's pretty vertically integrated. Most other car companies aren't even that vertically integrated. They literally just source the different parts from various suppliers. They don't even make the bits themselves. Really, like the Ford Motor Company is really just a stitching company. They just stitch parts together and then chuck the finished product out the door.
Yeah.
So they're going to be copping it as well, maybe for other reasons. But yeah, Tesla's definitely copping it because of the chip shortage.
Yeah, and I mean, even then, even in cars like Ford, where they're not fully or as vertically integrated as Tesla. I mean, you kind of forget what is actually being done. I mean, they're making a vehicle with so many different parts, and it's not like providing software. It's a huge project in a big factory, and you're pushing these cars through, and there's so many people involved, and so many parts and materials and logistics. It's you kind of forget that they're having to do that, and then some of these manufacturers are producing millions of cars a year. So it's when you think of it like that, and when you hear Elon talk about it like that, then it kind of grounds you a little bit, and you kind of understand. But yeah, hopefully next year is not as dramatic as this year, as Elon put it. But I guess we'll see. We really don't know what's around the corner. We've not known what's around the corner for the past couple of years now. So
yeah, it's crazy. I definitely want a new Roadster when it comes out. Man, that would just be the coolest car ever.
Yeah, it's
You were saying that you'd get around a Roadster.
I would. I mean, yeah. I go off and on. Really? I go off and on wanting to buy a car. Some periods I'm just like obsessed with wanting to buy a car, and then other periods I just think of it as a gross waste of money because I don't drive anywhere. So I'm kind of in the phase right now where I really am not interested at all in buying any car whatsoever. But I'm sure that'll come around. Focus on the house. Yeah, exactly right. Exactly. Yeah. Speaking of houses, I have a pretty funny story I wanted to go through, or hopefully it's kind of funny, but it's from CNBC. They put out an article about a real estate deal that quite possibly could be the worst outcome in real estate of all time. So strap yourself in for this one. Funnily enough, this is also in New Jersey, which was where the other story was about the deli.
Oh yeah, true.
So I don't know what CNBC is doing, but they're just like sourcing these funny stories out of New Jersey. So
some interesting stuff happens in New Jersey.
Yeah, keep them coming, New Jersey. Don't whatever it is. But basically, there's this property in New Jersey that's had one of the worst track records of all time, I think, and particularly over the last 8 years, it's really gone downhill for it. So let me go through the timeline of the last 8 years for this property. So in 2013, the property was listed for $39 million. So this is a massive property. This isn't just like a residential it is a residential property, but it's not just a house. It's 5 acres of land, 15,000 square foot interior, which is huge. 28 rooms, including 8 bedrooms, 9 full baths, and 5 powder rooms.
What the heck?
So it's a big house.
She's a mansion.
She's a mansion. Exactly right. And the original owners built it in the 1920s, so it's almost 100 years old, which is kind of crazy. And at the time, it was quickly dubbed the White House of Englewood, which is where it is in New Jersey. So you can imagine what it looks like. It's a big fancy white mansion. So that's where it started. It was listed in 2013 for $39 million. In 2014, after a year of being on the market, no one wanted it, so it was reduced to $25 million. So they thought, we'll take a bit of a haircut on it. We'll drop it by 45% or something like that. We'll maybe still sell it for a profit. I don't know what they bought it for, but dropped it down to $25 million. Fast forward 3 more years, still hasn't sold. So we're now in 2017, and it's down to 17 million is where they've listed it.
Whoa.
So they've gone, okay, 25, okay, 39 million was ridiculous. We were never going to get 39. 25, still no, but 17 million. We're now offering this at less than half of what we originally wanted, and it's been 4 years. So we've been
over 50%. Wow, jeez.
Yeah, and this entire time, they're paying a mortgage on this property, so they might need to sell the property to cover that mortgage, to cover the real estate deal that they've made here. So obviously the pressure's kind of building on them at this point. It's been 4 years. In 2018, the property was actually foreclosed on when the owners defaulted on the mortgage. So 2018 was not the year to be. That was their last chance to sell it before they had to pay their mortgage, I guess, or needed to get some money to pay it. The mortgage was actually $7.3 million. So that was their mortgage, and they were unable to pay it. So as a result, it was foreclosed, of course, by the bank, and it was listed again, this time for $12 million.
Okay.
So we're working our way down. We've gone 39, 25, 17, and now we're at 12 million. And we're 5 years into the history of this property trying to be sold. First by the owners, now by the bank, which owns it because the owners foreclosed on it. In 2019,
so they just want to get their money and run.
Yes, exactly. They just want to get rid of it. They want to, collect as much of that mortgage back as possible.
Just be done with it.
And be done with it. So another year rolls by. We're in 2019 now, and the price was cut again to $9.99 million. So they've done the old, $9.99 trick that supermarkets use to try and convince you that you're getting a discount when you're not. Yep. And they've gone for that method for the sale price. It still did not sell. Finally, it still did not sell in 2019. So we're now 6 years into this property trying to be sold, and we're 75%. The price is 75% below what they originally asked for.
What the heck? How is this possible?
Yeah.
Did the rest of the house owners on the street get murdered or something?
It's a murder house.
Geez, we don't want to live there. We're next in line.
Yeah, I mean, well, we'll get to some reasons why it might have dropped so much, but 2019 still wasn't selling. Another 2 years go by, so of course we're in 2021 now, and finally the property has been sold. So they finally got rid of it. What do you think? Do you have any guesses for what it sold? Obviously, it didn't sell for. Well, maybe it did sell for the 9.99 million.
Oh, well, you've just given it away now. It didn't sell for the 9.9. So it started at what, 39 million? I don't know. I mean, I am looking at the property right now. I looked it up while you were talking, and it is a big, big house.
It's a nice one.
Huge. But geez, I don't know. Maybe 8 million?
No, unfortunately, it sold this year for and I say unfortunately, it's still a lot of money, but $4.6 million.
Wow.
Which was 88% below its 2013 asking price of $39 million. While, of course, the real estate market has gone up over that time, right? Not only have they not got what they've asked for, significantly lower than that.
But, I think it's fair to say they didn't get what they asked for.
Yeah, I don't think they're too happy with that. But of course, that amount is also below the loan of the house that was originally taken out. So it didn't even cover the loan for the bank. And the kicker of this as well is that someone actually offered more for the house before their sale, but the owners declined it.
Wow. That's brutal.
So that's a painful outcome. It's not what you want when you invest in a property, but it can be what happens with some of these high end properties, because I mean, at the end of the day, it's of course only worth what someone's willing to pay for it. So, some of these mansions have huge price tickers on them. But yeah, they don't sell very often, and then their prices obviously vary massively depending on who's available to buy it. Especially, I mean, think of a $50 million house. I mean, there's not that many people in the world who would afford a house like that. I mean, you're talking about people who have a net worth of hundreds of millions or in the billions. So you're already limiting yourself to a significant amount of people, and you're obviously limiting it to a certain area. But the article kind of cited a couple of reasons why it might have dropped so much. One of the main things is the property tax bill that's associated with owning this property. It's massive. So they have to pay annual property tax of $163,000. So that's just property tax every single year.
That's
so
brutal.
Not cheap to own a property like this. And the property also needed about $3 to $5 million worth of renovations. So,
okay.
Someone paid $4.6 million. They're probably going to put in another $3 to $5 million in renovations, and in the end, their cost has been about $9 or $10 billion, $1 million, not billion. So there's that. And the other reason they cited also was that the property was also corporate owned. So it wasn't owned by just an individual, which means that every time that a deal came to them, someone made an offer, it had to be agreed on by a board. So the board had to kind of meet and then decide on it. And then if they didn't get the votes, then it wouldn't sell. So it makes it a lot more difficult to sell a property when it's corporate owned than if it was owned by an individual. But there you go.
Yeah. Wow. There you go. That's crazy. I'm just thinking, like, I just ran the numbers on if you got 88% off of like an $800,000 home, you'd pay $96,000 for it. It's like, why can't that happen everywhere in the housing market right now?
Yeah, I know, right? That would be nice. Yeah, the rest of a lot of Australia is just going up and up and up.
Yeah.
At a crazy
I read
rate.
somewhere that's like the quickest rise in Australian property values since like 1989 or something.
Yeah, I saw that too, actually. Yeah.
My eyes glossed over that. I didn't click on it or anything, but yeah.
I saw one that said, I think it was in the US maybe, that they had the biggest monthly increase since, I think it was 2007 or something, just before the global financial crisis. It was a crazy year-over-year increase. It was, I think, 15% or something like that, which is kind of insane. But New Jersey, bringing the funny stories to the Young Investors podcast. So I'll have to look into what other funny things have happened in New Jersey, because it seems like that's the place. I've just insulted a bunch of people from New Jersey.
No, we love New Jersey.
Yeah, we do.
New Jersey is, I don't know. I wonder if you're listening to this podcast right now from New Jersey, please go to the YouTube version of the podcast and let us know.
Yeah.
I wonder if there's one person out there that's listening to us right now from New Jersey. Do you reckon there is? What would you reckon? Maybe?
I mean, maybe there's been one person at some point who has listened to the Young Investors podcast. I think that's more likely, but I don't know about right now. That would be pretty insane. If so, please go visit the deli and let us know.
Yeah, go buy a nice cheddar from Hometown International for us. Sit back and enjoy it. Get some nice crackers and just enjoy.
Yeah, exactly.
All right, let's move on. Should we talk about we got to talk about China?
Yeah,
right? Man, wow, holy smoke! I saw this news story come up in the media this week as well, and it just blew my mind. Holy moly, what's going on, Hamish? You got to tell us.
Yeah, well, I mean, there's a lot of things coming out of China at the moment, and it's kind of it's the flavor of the last couple of months, particularly because of Alibaba, the investment that has been made by a lot of big value investors. And Brandon actually put out a video on New Money this week that goes through Alibaba's business and their revenue streams and that sort of thing. Really good video, so I highly recommend you check it out if you haven't seen that.
Thank you, friend.
Just a little plug for you there. But this week,
I appreciate it.
We got some new legislation that came out of China. Basically, kids and teens that are under 18 years old will now only be allowed to play video games for up to 3 hours a week. So,
wow.
I would not.
Wow.
I just got to say, I would not have survived. I used to play. I used to play so much video games as a kid, particularly like after school. It would be a minimum of 3 hours a day, probably 4 or 5 hours a day some days. So, yeah, that's come through. Specifically, under 18s can play video games 1 hour per day on weekends and legal holidays, and it has to be between 8 and 9 p.m. So not only are they limited in how many hours they can play, they're limited when they can do it, which is only on the weekends, and it has to be between 8 and 9. So if you you can't play 9 till 10 or 6 till 7, 8 till 9. If you miss that window,
you got a family dinner that night, no, you miss out.
Yeah, exactly. So it really is up to 3 hours a week. If you miss those windows, you can't play outside of those windows. So this, of course, is a big blow to companies like Tencent and other online game providers. And I think the first question that I thought of when I saw this headline was, how on earth do you enforce this? Like, how do you enforce what someone does in their private home? Like, how do you go about that?
I think that's why they can only do it to online game providers, right? Because as soon as somebody's offline, then what? They're going to have the police go and knock on everybody's doors. So I think I'm right in saying that it's just online games that are being this rule's being enforced, right?
Yes, I believe so. Yeah, and I mean that's really the big story as well, because of the companies like Tencent that offer a lot of online gaming. But the way they're going to do it is online game providers like Tencent will only be able to serve users who have logged in and have used real name registration. So basically that allows, that kind of is supposed to prevent companies from just turning a blind eye and saying, well, I don't know how old the people are on my platform. Like, I don't know. It's, none of my business.
Yeah.
They have to make people log in and say, I'm this year's old, or this is my date of birth, and this is my name. Like, this is my, legal name. But interestingly, I mean, not really that, I mean, it's kind of not surprising, but Tencent says that it supports these new rules, and it actually made some preemptive changes to their business in anticipation for something like this. In July, earlier this year, they actually introduced facial recognition scans so that users can verify that they are adults. And I don't really know how that works.
Yeah.
I don't know what that means. Does that just mean you have to upload a photo of your face as well as your name so that they have a kind of a record of it, and it's kind of a bit more of a preventative measure from kids logging on? But I'm not really sure. But Tencent is, of course, on board with it, as they kind of have to be. So that's kind of one of the things that they've introduced.
Yeah.
Yeah.
Maybe this facial do you reckon this facial recognition thing is so they can log in, so that they can tell? Because otherwise, I can see that if you're a parent in China and you just don't agree with this ruling and you just want to let your kids play video games, fair enough. You could just make an account, verify it yourself, and then just let your kids play on your account.
True. Yeah. Pretty much.
So maybe this is some sort of facial, like you have to, use ID or something and verify your identity, and then each time you log in, maybe you have to do a facial scan. I don't know. But,
okay. Yeah, that makes a little bit of sense. Yeah.
Maybe that's China's way of making sure that when the person logs on, it actually is the real person that the account says it is, or I don't know. But yeah, wow. Geez, I don't know. Like, yeah, I get it. Kids, sometimes they go a little bit crazy with the video games. They play too much. But, man, surely when I hear about a story like this, my mind kind of just says, surely there are more important things in the world to be worrying about than how many hours per week a kid plays a video game for. It's like, surely there is some more important stuff going on where we should be devoting our time and energy in regulation and restrictions.
Yeah,
but I don't know. I guess China's just a different beast, isn't it? They really like to flex their muscles to control or to make things the way they want to be. They're not afraid to do something like this. I think it was only a couple of weeks ago, wasn't it, where they flexed their muscles and just destroyed, the for-profit education industry in China. They just, those companies just aren't allowed to operate at a profit anymore. They just made a rule. So it literally just wiped out that whole industry. It just doesn't exist anymore. For-profit education just doesn't exist. So they're certainly not afraid to just go, you know what? Yeah, we'll change this. Oh, what? You don't like it? Too bad. We're going to do it anyway.
Yeah, I think
it's just the way that it works over there. It's just different. You can argue that it's good or it's a good thing or it's a bad thing or whatever, but it's just different. It's just the way it works.
Yeah, exactly right. I think the way to think about it is it's kind of, I mean, every nation to some extent pushes laws that change, that kind of push people's behavior, citizens' behavior in a certain direction. It's just whether, like, to what extent that happens. Like in Australia, for example, we have extremely high taxes on cigarettes, right? And the reason why we do that is because we want to dissuade people from smoking cigarettes because of the burden that it puts on the health system, and that, it's not good for people. So that's a behavioral push that legislation, that's what that legislation does. It tries to push people away from cigarettes, even though, at the end of the day, you should be able to just kind of, you can do whatever you want. You're just going to have to pay a little bit more for it. So those kinds of changes, those kind of behavioral laws kind of things happen everywhere. It's just to, like, what extent does that happen? You wouldn't see.
And the method of implementation, like for us, it's obviously taxes and incentives, whereas there it's just like, no, we're just changing the law.
That's true as well. Yeah. So I think the other thing important to note here on this story is that while these restrictions are strict, they're kind of in line with similar restrictions that have already been in place. So in 2019 was when the previous legislation around this was made. Gaming was already restricted for under 18s to 1.5 hours a day on most days. So there was already, significant restrictions. It wasn't as if you go from play as much as you want to 3 hours a week during these, during 8 and 9 p.m. on a weekend. There was already restrictions that just got tighter. So that's kind of important to understand, I guess, in the context of what's happened here. But yeah, I think these stories are important to kind of think about because, it is a big cultural difference in how things are governed. And of course, they want to have a thriving economy and businesses that compete globally, but clearly they don't mind hurting those businesses in pretty significant ways in order to achieve other goals, right? So in this case, it's to kind of protect children from addictive games and becoming addicted to gaming and regressing from society or whatever people think people who play a lot of video games do. But clearly they don't mind hurting businesses even as big as something like Tencent. In order to do that. So that's the latest thing that's come out of China. We'll kind of see what happens next week or the week after.
It's interesting.
Yeah.
Interesting. I'm just starting to learn about it. Like, obviously I've tried to do a bit more of an in-depth dive into Alibaba recently, and with that you have to do a bit more of an in-depth kind of dive into China and its policies and how it works, and I'm really just learning about it now. But it is quite interesting at just how different it is.
Yeah.
But, we'll have to see.
Yeah.
I don't know. I don't know if I'd like to live if I'd like to be a Chinese citizen. To be honest, don't know.
I mean, obviously, probably biased to some extent by where you grew up, but I certainly believe that I certainly like that those kinds of decisions with, like, gaming, for example, would be made at, like, the family level, that parents can kind of decide, because I mean, I think every kid is different. I think for some kids, gaming is clearly addictive, and it clearly makes some kids, regress from performing at school, for example. But for other kids, maybe they're really good, and that's a career path, right? And you don't want to stifle that. You want the kid to be able to play, maybe a reasonable amount. But ultimately, I personally think it should be at the family level, where, if a kid is playing too much, the parents can just take it away, and then they can set the rule between 8 and 9 on weekends. That's when you can play, if they want to have that rule. But Yeah, it's
Yeah.
very
Seems fair. But yeah, just different strokes for different folks, right?
Yeah, exactly right. Do we have any other stories to talk about, or should we get into some Q&A?
There's this one I could fly through, which I found interesting. Or we could just get into Q&A. I don't mind. What do you prefer? I'll fly through it. This one's been sitting here for a while because I just found it interesting. I'll just put it in. But I think the last few episodes it's just been so jam-packed that we haven't really spoken about it. This is just an interesting story that I found on ABC. They did like a special report on it on ABC News or whatever it was. And it was actually about the title is Fast Fashion Turning Ghana into Landfill, which is kind of interesting. I'll just read you what's going on here. So it's actually quite interesting. It says it's the dirty secret behind world's fashion addiction. A huge proportion of the clothes we donate to charity end up dumped in landfill, creating an environmental catastrophe on the other side of the world. It says a high portion of garments sourced from clothing bins and charity collections are shipped to Ghana for resale and reuse. In fact, about 15 million used garments pour into Accra every week from the UK, Europe, North America, and Australia, flooding the city's sprawling clothing market. Every year, as many as 4 million tons of used textiles are shipped across the planet in a trade estimated to be worth $4.6 billion.
Whoa.
But an estimated, this is where it gets crazy, 40% are of such poor quality they are deemed worthless on arrival and are simply dumped in landfill.
Oh my God.
And at this point of the story, they showed this picture, which is crazy. It's like just on the side of one of these big secondhand or these charity bin kind of clothing markets. There's just this huge cliff leading straight down into a river, and the cliff is made of clothes.
Oh my God.
Yeah. It's not even made of dirt and rocks. It's made of clothes.
Wait. So these are clothes that have been donated to charity because people don't wear them anymore, and then they're shipped over to Ghana to be donated. Is that right? And then just a significant portion, 40%, are so poor that they just go into landfill.
Well, it's actually a market. So I did a little bit of reading of how these clothing. So it's a market. Yeah. How do these clothing markets operate? So. What happens is it gets shipped over. So we donate, and then it goes over. And what happens is a lot of the business here is entrepreneurs. What they do is they try and find clothes, from these charities that are in decent enough condition, and they buy them. And so they buy the secondhand clothes, and then they mend them so they can be sold at a markup. That's kind of the business behind it. It says in Accra, where some 60 containers of used clothes arrive every week, the industry can be highly profitable, but it carries an unusual business risk. Importers can spend as much as $95,000 on a container of clothes and have no idea what they're buying. So it says if the clothing is in good condition, profits can quickly tally to as much as $14,000. But if the clothes are torn or stained or long out of fashion, their importer may as well have put a torch to their money.
Wow.
Which is pretty interesting. One thing they did do is they actually interviewed a man by the name of Emmanuel Ajab, who is one of these entrepreneurs over in these secondhand clothing markets. He told the reporter, apparently this business used to be very profitable when he started 17 years ago, but the main problem now is firstly at the manufacturing level, the clothes that are made today are of much poorer quality. Because obviously companies are just trying to reduce costs, and they don't really want their clothing to last very long. So that means you won't buy another jacket next year, kind of thing. Yes. So that's the first problem. But then at our level, this is something that we can contribute to. We donate clothing that is in very poor condition. It says here, the quote is, "As I watched, Ajab opened a bale from Australia and quickly separated out those clothes which might be resold at a decent price from those which were worth far less. Familiar labels flash by, such as Suzanne Grey, Target, Zara, Billabong, Just Jeans. Just a few garments landed on the high quality pile. Out of the 180 light summer jackets inside, 85 pieces were unsaleable. Collars ringed with sweat, buttons missing, blood stains on the sleeves." He threw his hands up in the air. Quote, "It's an insult," he said. "Assume you use your money to buy this bale. How are you going to survive?" This bale cost him $90. In the end, he sold $20 worth of clothes. Wow. The rest were put out with the rest of the rubbish.
That's crazy.
Yeah, it is pretty crazy. So I think it's an interesting story because there's two sides. Like, interesting that we donate these clothes and it does create a market, and it's estimated that this has created 2.5 million jobs in this clothing market, according to the local used clothing dealers association. So it's certainly helped a lot of people, but it's also now slowly crushing these poor workers' livelihoods and causing environmental problems at the same time. So I guess the thing that I took from it is, overall, one thing we can do is we need to firstly reduce the amount of the volume of clothing, I guess, that we consume. But also, when we donate, we just have to make sure we don't use the donation bin as a garbage bin. We actually have to donate things that are of decent quality. So
yeah, it's
I thought that was interesting.
Yeah, it is. And I mean, man, it's just such a cultural thing, I think, for people to want to have so many different clothes. And to wear things once and then throw it out. And there's so many websites. I think Shein is one for women's clothing that is a really bad offender, where they have really bad practices on the manufacturing side. And you're buying clothes that are like $6 for an item. So it's very easy for people who, anybody to just buy a lot of clothes and to not really wear much of them. It's a tough cultural thing. I'm sure social media has exacerbated it as well, with people needing to post things online that don't you dare get caught posing in the same clothes as you wore the week before. I don't know.
So true, actually. I get comments sometimes where, to be honest, I'm not one of these people.
Oh,
like
no.
I buy my clothes and then I wear the hell out of them. And sometimes I get comments where it's like, man, are you wearing that same jumper? That's the same jumper you were wearing in that last video. It's like, man, you really only have like 5 or 6 different shirts that you like to go through. It's like, because you don't actually need that many items of clothing. I mean, I had a friend which would always say he wanted to look fresh. So he would only wear his jeans like a few times before buying a new pair. And to me, that just blew my mind. It's like, dude, you can wear these jeans for like years and years and years. But it's definitely not the way I kind of view clothing. I'm certainly more of a buy and wear the hell out of it. But is that kind of your approach as well?
Yeah. I mean, I'm radically the same as that. I think I usually go shopping like once a year. If that. I've even had years where I don't even buy anything, or at least it feels like that. I mean, I really don't care at all. I think I have like 2 pairs of jeans and like 2 jackets, and I just rotate the 2 jackets, and all my t-shirts are from Kmart. So
I like it.
I mean, it's never been something that I've particularly cared that much about. So that's just kind of the way I've been. But it's I think we're certainly the outliers in at least
Probably.
in Australia. Most people love to indulge in buying a lot of things, and it's
love to shop.
No, it's interesting to hear kind of a story like that, because you don't really. I honestly had never even thought about that. I just have always assumed, you're donating things, like as long as it's in decent condition, you're obviously doing something good. But it's important to kind of hear those sides.
Yeah, I always just think, if I'm donating something, it's probably going to somebody that doesn't have any clothes at all, kind of thing.
Yeah.
But that's clearly not the case. It actually goes into a secondhand clothing market in poorer countries than Australia, but it's still important to, like, obviously there's still consumers over there, and they're not going to buy, secondhand clothing where it's got massive blood stain on the sleeve or something like that, which makes sense. I guess we've just got to donate items that are actually in good nick. Maybe just stuff that we don't wear anymore, but if it's garbage, then put it where it belongs, in the garbage bin.
Yeah, exactly right. All right.
But anyway, interesting story. Q&A time. Let's go.
Yep. All right. I got one for you. Hey guys, I've just started listening to your podcast and love it. Well, thanks for tuning in. I'm glad you're enjoying it. Question I have for you: other than Buffett and Munger, who are some of the other value investors that you follow?
Well, I definitely follow Buffett and Munger the closest, definitely, by a long way. I definitely follow Monish Pabrai a lot more than I used to these days. I think that's been helped as well because he's actually putting out content fairly regularly. So yeah, I definitely follow Monish Prabrai. Like I'll look at all the 13Fs really. I'll just see what Seth Klarman's up to. I'll see what Guy Spear's up to. Phil Town is obviously someone that I'm really interested in because when I first started learning about the Buffett approach, Rule 1 was the way that I really got into the nitty gritty of how that 4M system really worked. So I like to follow what Phil Town's doing, what he's talking about on his podcast and his YouTube channel. Yeah, is there anyone else? I keep up to speed with what Ray Dalio is talking about, but that's just more me trying to understand the macro a little bit more and keeping track with the macro. He never would do like an individual stock, like, oh, I've been investing in this stock lately because of X reasons.
Yeah,
I don't know. Are there any more investors that you follow?
Yeah, I mean, the only one I can think of beyond the ones you just mentioned would be Nick Sleep, who's obviously a lot less well known than the ones you just mentioned, but he ran a fund for those who don't know from 2002 to 2014 with a 21% per year compounded return, and he every year or every 6 months actually he did a letter. His fund was called the Nomad Fund, and he did an investor letter kind of similar to Berkshire's style, where he went in detail about his philosophy, and they're just really interesting to read. So I've been diving into him a little bit, but a little bit trickier to follow because he's from the UK, so. He might have other investments, say in the UK, and
not reported.
Yeah. So, yeah,
very interesting. And Nick Sleep is someone that I want to follow. I just haven't gotten around to it yet. I want to read through his letters, but I just haven't done it yet. Okay, cool. Should I do this one? Let's see. Hey guys, love your podcast. Oh no, this is one. I guess you could answer it too. Hey guys, love the podcast. I recently saw a video of Brandon where he values a company's stock based on the discounted cash flow method. Why is it you value the company based on its latest yearly cash flow? If that year's free cash flow was abnormally high or low, wouldn't the valuation be unreliable to project future cash flow? I'd love to hear your thoughts on this. Yeah,
I mean, most of the time you are able to use last year's cash flow, but certainly if it's abnormally high or low, that's the case with, I would say, most businesses. If we're looking at 2020, for example, or even 2021 financial year, in that case, I'm using an average. So I'm using an average of usually 5 years, although I guess you could use 3 years as well. And that's kind of a way of normalizing your starting cash flow in the DCF. And then, that's going to give you a much better projection because, I mean, particularly in 2020, you have quite a wide variety of abnormality. You have some businesses that were either not profitable, or maybe they were really profitable businesses and now they're losing money, or they would just had really low profits. And then on the other end of the scale, you have things like grocery stores and retail stores that had abnormally high profits. And I'm sure there's other businesses you could put into that camp as well of abnormally high profitability. So, you want to normalize that to some extent. And you can also normalize it to some extent as well in your growth projection. So from that point onward, if you did want to use last year's cash flow, you could project, say, in the next year that cash flow declines or is flat, and then it continues growing. So kind of accounting for the for cash flows going back to normal in the next couple of years, and then whatever growth projections you have. So that's kind of how I go about it. But in most cases, which is, a pandemic doesn't come around in most cases, in most of the time, but in most years, you will be able to just use last year's cash flow. So that's kind of the default method.
Yeah, I agree with what you just said because I'm just thinking, like, imagine you had a company that, had a massive, massive drop in free cash flow in 2020, but it was because of the supply chain and, the chip shortage meant that they weren't able to manufacture any of their products. and so their free cash flow was terrible. But is that maybe they've added more a bigger backlog of orders? So maybe as soon as the chip shortage finishes, maybe in a couple of years, they'll be straight back to where they were before, or they might even be posting higher revenues than pre-pandemic because of this backlog. So I think it just comes back down to your understanding of the business. That's really what we always say. Yes, definitely, if there's an abnormality, you wouldn't just want to take that cash flow and grow it. And you'd be like, in 10 years, it's going to be back to where it was right before the pandemic, because it might actually be back to pre-pandemic in like a year. But it just comes down to your understanding, I think.
Yeah, definitely. All right, we'll do one more. I'll read this last one to you.
All right, sure.
Hi, Hamish and Brandon. Do you worry about the tangible book value of tech companies? For example, companies like Facebook, Google, Netflix, etc. They have big profits but tiny tangible book values relative to their market caps. Any advice there?
Yeah, well, I mean, the way I think about it, like if a company was going to be liquidated or broken up and sold, all the individual tangible pieces were going to be sold off, then that would definitely be something that you'd want to look at, is the tangible book value. But I actually, for me, when I look at business models, I actually really like the fact that these tech companies can generate substantial profits without actually needing huge tangible, significant investment in, that tangible infrastructure. I was reading about it recently, how Alibaba goes about their logistics services. It's they describe it as an asset light approach. For example, Alibaba, their business in logistics actually coordinates all of the couriers and provides, data insights into more efficient logistics management, as opposed to actually building the infrastructure to handle the actual deliveries themselves, kind of thing. So I don't know. I feel like I like seeing it in these big companies, these big, techie companies, because it just means that, they don't have to spend a lot of money to invest in physical assets, but they can still generate substantial profits. It means that, their real gem of their business is in their software as opposed to any physical assets. I don't know. Do you have any thoughts on that?
Yeah, I think it really just comes down to like what layer of protection is around their intangibles, because some businesses have really low tangibles and maybe they're really profitable, but if they don't have a deep moat around those intangibles, so in other words, if those intangibles don't really have much long-term value, then yeah, that's certainly a concern, because there might be nothing left after those intangibles stop producing cash flow. But for something like Facebook, for example, they don't have a lot of physical assets relative to their profits, for example, but they have a massive networking effect, right? And that is not tangible, but it has a significant, it's very valuable. Yeah, it has a significant impact on their survivability. So that's kind of where it sits. It really just depends on whether they have a deep moat around them. And some tech companies will be really profitable for a short period of time, and they won't have a moat, that it will go away, that competition will step in, and they will do a similar thing to what they do, and the business will just start to struggle. I think probably, maybe this isn't a perfect example, but Uber certainly could fit into that category, and you could argue with this, but particularly with something like Uber Eats, there is a lot of competition now for that service, and the service is extremely replicable as long as you can get drivers on board, and as a result, it can be a very low physical asset business, but if they can't remain competitive, keep their drivers, keep their customers, then you're right, then there's really nothing left after that. So I hope that kind of helps with that question.
Yeah. All right. Should we wrap things up?
Yes, let's wrap it up. Thanks everyone for tuning in as always. If you do have more questions or topics that you want us to cover in future episodes, then head over to the YouTube version of the podcast at youtube.com/The Young Investors Podcast. Just click on the latest episode and leave your questions or topics as a comment below that latest episode. And thanks Sharesight for sponsoring as always. Head over to sharesight.com/young investors to get 4 months offer yearly subscription or sign up to a free plan for as long as you want if you want to try it out. Thanks, Brandon, for joining me as always.
All good.
And I hope everyone has a good weekend.
Yeah.
See you later, guys.
See you guys.